I'm Yahoo Finance executive editor Brian Sozzi. You're taking a look at a live shot of the opening bells of Wall Street on this Tuesday morning. Really star-studded folks ringing those bells today. Ralph Laurencio, Patrice Louvet ringing the bell at the New York Stock Exchange ahead of its Investor Day presentation. The company's out reiterating its full-year guidance. And American Bitcoin getting things underway over at the NASDAQ. You can see Eric Trump there ringing that bell. Big and bullish over crypto is Eric Trump. Now, markets are anxiously awaiting Fed decision day on Wednesday, but they aren't waiting, of course, to price in what the Fed may announce. Stocks are trading at record highs as investors ready for a 25 basis point rate cut and a signal more rates are coming. Let's get a quick check on the markets on Fed decision eve and send it down to Yahoo Finance senior reporter Ali Canal at the NASDAQ in Times Square. Ali.
Hi, Saz. I love that. Fed decision eve. And we've had a lot of record highs leading up to this moment. The NASDAQ notching its sixth consecutive record high on Monday. We saw the S&P notch yet another record. And at the open here, all three major indexes opening in the green. This comes after retail sales came in better than estimated. And there's just a lot of conversation right now on Wall Street on how much room this rally has to run, especially since we've been getting some conflicting signals when it comes to sentiment data. Main Street seems to be a little more pessimistic. Wall Street seems to be optimistic. That Bank of America Global Fund Manager survey showing the most optimistic survey since February. So still a lot of potential catalysts ahead, especially with the Fed expected to resume its easing cycle. To that point, you'll see the Russell, the small cap 2000, that is up roughly 0.3%. And over the past 3 months or so, that index has outpaced the broader S&P 500 due to those expected Fed cuts. If we take a look at some trending tickers as well, you're going to see names like Oracle at the top of that list. The stock is once again rising after the U.S. and China reached that preliminary TikTok deal. We also saw Oracle shares surge last week following its earnings report. And then Alphabet, this is a stock we'll be talking about throughout the show, but this became a company that reached that critical $3 trillion market cap. Only a handful of companies have been able to accomplish that. And Wall Street seems to think that there is more room for the stock to run when you look at potential AI advancements. And you're seeing on your screen there, those are the companies that have hit that $3 trillion mark, Brian.
Ali, the team telling me in my ear to leave cookies out for Jerome Powell on Fed decision eve. Maybe we'll do that in advance of rate cuts. All right, thanks, Ali. Appreciate it.
I'm in.
All right, me too. Here's what I'm watching to kick off the trading day. Markets are on Fed watch, as we just mentioned. Investors have sent stocks to record highs in the hopes the Fed not only cuts rates on Wednesday, but signals more rate cuts are coming within the next 6 months. But some on Wall Street are now chatting about Fed Day being a sell the news event for the markets. Does that argument, though, really hold water? We'll put it to the opening bid roundtable. And another tech giant to the $3 trillion market cap club. Shares of Alphabet are still catching a bid after the company joined the $3 trillion plus market cap club alongside Apple, Microsoft, and NVIDIA. Although I would note NVIDIA's market cap is $4.3 trillion, the only company to be above $4 trillion. The next player that could enter this rarefied air is Amazon, which currently sports a market cap of about $2.5 trillion. For more fodder here for our roundtable, we'll bring them all in right now. Tom Essay, Sevens Report Research founder, and Yahoo Finance senior reporters Ali Canal and Brooke DiPalma. Tom, let me get over to you here. Like we've been talking about, Fed decision eve here. The market seems to have priced in a 25 basis rate cut point at this point in time. What could surprise the markets?
Good morning, Brian. Thank you very much for having me on. I think a 50 basis point cut would be a surprise. If we look at FedWatch from the CME, it's like a 5% chance. But it's two parts, right? We would need to see a 50 basis point rate cut, and then the dots also show 2 more rate cuts between now and year end to give us 100 basis points of easing versus the 75 that's currently expected. On the flip side, if the Fed cuts 25 basis points and the dots just show another cut between now and year end, that's going to be a major hawkish surprise. And I think you could see the markets kind of tumble if we get that, because it would sort of be a bait and switch. The Fed has led the markets to believe this is the start of a rate cutting cycle. And if all of a sudden they switch it, that's going to be a negative event.
I know the labor market has slowed down, Tom. We've been covering that a lot here. But is the economy that weak to justify what, like you just mentioned, 100 basis points worth of cuts?
No, it's not. And certainly there is some labor market easing, but we're still talking about jobless claims at 260K. I mean, Brian, you can remember 10, 15 years ago, we would have prayed for that, right? Even the unemployment rate is at 4.3%, still historically low. The issue with rates is that the Fed believes that they're restrictive, too restrictive for where the economy is. And the reason they're here is because they're scared of inflation coming from tariffs. Well, we can't wait forever for the inflation from tariffs to show up. Otherwise, you will drive the economy into a no-growth environment. I think that's why they are going to cut here. The big question is how aggressively.
Yeah, Tom, I think 20 years ago, I was watching these numbers as they crossed the terminal, making $25,000 a year. I mean, look, if you work hard, you can really make it. Brooke, over to you. To Tom's point, retail sales weren't that bad this morning.
Yeah, retail sales actually came in better than expected, and we are getting some commentary on the street, particularly from Greg Dacko over at EY, and he really pointed to the fact that there was 3 key categories that really drove these August sales. That was online purchases, clothing and sporting goods, hobby, musical instruments, as well as books, and that really shows the robust nature of this quote-unquote resilient consumer that we hear about time and time again. They continued to show up for these particular seasons, in particular in August, you think back to school. And we saw that. In addition to that, it's worth noting that we also saw a rebound when it comes to spending at restaurants and bars. That rebounded 0.7%. He said that appears to be a more temporary bounce, likely supported by the rise that we've seen in the equity market, the strength, these record highs that we've seen, and also seasonal enthusiasm among high-income households. And we continue to hear about how this high-income households, that person making over $100,000, is really contributing so robustly to this economy right now, and that was pointed out by a Moody's note this morning. And so largely what we saw in these retail sales is that consumers still continue to spend despite this overarching fear that we've been discussing since the start of the year about how exactly tariffs will impact consumers' wallets. And right now, that high-income consumer seems to be largely shoving it aside and really contributing largely to this economy.
It's good to see people out there buying books, Brooke. Are those physical books? I mean, does the retail sales report actually tell you, are those physical books from Barnes & Noble?
Well, non-store retailers did outperform the rest of the sectors, and so maybe they're buying their Amazon Kindle for us.
Al, let me get over to you here. Look, it doesn't seem like this is an economy that warrants a 50 basis point rate cut, so 25 would be good. At what point, though, has this all been priced into stocks?
Yeah, and that's the big question heading into this report. Is it a sell the news event? Could we see some potential reaction or volatility there, even if we do get 25 basis points? I don't think it's really what we see from the actual cut. I think it's what the dot plots show us. What is the change of the language? Does he lean more dovish, more hawkish? Those are the things that investors are going to be closely focused on. I mean, markets are pricing in a total of 3 basis point cuts, including Wednesday through the end of the year over the next 12 months. Bank of America's fund manager survey has 4 cuts priced in. If the dots show that that is maybe a little too dovish, that could be something that could provide some volatility to this market. And maybe it's a dip buying opportunity as well, considering the consecutive record highs that we've seen. But overall, sources that I've been speaking with, strategists, economists on Wall Street, it's clear one of the main things that are driving stocks higher is the expectation of Fed rate cuts. Layer on top of that the AI productivity boom, the earnings momentum that we've seen, not just with the Mag 7, but across various sectors of the stock market. And you have this recipe for a continued bull market run. The big question mark is the economy. If we see stagflation, if the unemployment rate ticks up and the labor market deteriorates, at a certain point, bad news is going to be bad news for the stock market again.
Tom, there's only so much Fed chatter I can do. I'm just burned out of Fed chatter, at least until tomorrow afternoon when Powell hits that stage. Let's talk some tech stocks. Google crossing that $3 trillion market cap figure. Does that excite you? And when a company hits these big round numbers, what's the message there?
I mean, I think it's fun, right? It's a nice headline, and congratulations to all the Google investors who hopefully are doing very well. I think the headline there is that the AI enthusiasm-led rally continues, right? We got a very favorable court ruling for Google and Apple last week, which helped continue this momentum, but it really was the few weeks before that too. Oracle posted very strong backlog, as we know. Before that, Broadcom posted really good guidance. So the whole AI story still has legs, and I don't think there's any reason that an investor should exclude Google from their AI tech basket. Yes, it's not so much on the infrastructure side, like a semiconductor company, But with Gemini and with the advancements they've been able to make in optimizing search and advertising, I think Google belongs. And I think this just tells us more broadly, tech is still the market leader until it isn't.
Tom, you think Amazon's next?
I do. I think that the CapEx boom we are seeing, and this is really for investors, the key with AI is watching capital expenditures, which is a really fancy term for companies spending lots of money on investment in infrastructure and other things. The CapEx boom is spreading throughout the economy. I think Amazon is in a great place with all their cloud infrastructure through AWS. I think they continue to be a winner.
Is there another company, Tom, that could join NVIDIA over a $4 trillion market cap? Or at this point, I mean, this is NVIDIA's territory. They should be isolated on an island by themselves.
I think that's fair enough. You know, certainly I would look to some of the other large cap tech companies like a Microsoft. Apple is sort of an interesting candidate because they've been so late to the party, but have recently rebounded. If all of a sudden people begin to believe there's an AI story with Apple, who has been very restrained in the AI race, or restrained or unsuccessful, depending on your opinion, then they can play catch up as well. But I think stick with these mega cap tech stocks. The momentum is still in their favor, and so are the facts.
All right, a big thank you to my opening bid roundtable for today, Tom Essay, Ali Cannell, and Brooke DiPalma. Appreciate it. Straight ahead, the bullishness on CoreWeave rages on, and in our Power Player segment, Okta co-founder and CEO Todd McKinnon stops by. Okta shares are up a sizzling 18% in September alone. We'll be right back with that interview. Welcome back to Opening Bid. Cloud infrastructure company CoreWeave is still seeing good interest on the Yahoo Finance platform. As follows news, it has entered into a new $6.3 billion cloud computing capacity deal with long-term partner and investor NVIDIA. Citi analyst Tyler Radke thinks the deal is quite bullish for CoreWeave. Says Radke, it highlights NVIDIA's role not only as a GPU supplier, but also as a CoreWeave investor, solidifying its collaborative future, we believe. CoreWeave is one of our top picks, with a revenue acceleration to 2026 amid continued capacity constraints and a robust demand backdrop that moves to integrate up and down the tech stack. Radke sees at least 35% more upside in CoreWeave shares. All right, in today's Power Player segment, I'm stepping back into the world of cybersecurity after some really great chats at the Goldman Sachs Tech Conference last week. Today's focus company is Okta, a leader in identity security. The stock has shot up about 18% in September on the heels of a well-received second quarter earnings report. The company appears to have gotten its prior Salesforce issues under control and is winning new business in the government space. And these attributes led to Okta offering up a more upbeat outlook for the full year. So in light of all this, I find it a little off that Okta shares trade at a discount on a forward PE basis to other cybersecurity plays like Palo Alto Networks and CrowdStrike. Source for all of these numbers, of course, Yahoo Finance data. Let's dive in here with Okta co-founder and CEO Todd McKinnon. Todd, always nice to see you. Thanks for waking up early for us here on Opening Bid. Lots going on AI, to say the very least. You had the big results at Oracle, a lot of bullishness in the chats that I had at the Goldman Tech Conference last week. What inning is Okta in all things AI?
Well, I think we're off to a good start, but it's still very early. And if you zoom out and look at the past 15 years of our business, at first, it was about building this infrastructure layer, this identity layer, connecting all the people and the resources that helped the transition to cloud. The second was security, where everyone really woke up and realized that identity management was imperative for security. You couldn't have strong security without multi-factor biometric authentication and access control everywhere. And now what's happening as everyone rushes to deploy AI agents, everyone's realizing that you can't deploy AI agents unless you get your identity foundation correct. You can't have these agents running around your company connecting to everything unless you know what they're connecting to, what they have permissions to, what kind of data they can access, making sure none of the credentials get leaked or none of the passwords get exposed. And that's what we're all about, and we're excited to power this layer of the AI agentic boom.
Todd, these agents are already infiltrating major companies. This sounds like a potential disaster scenario for very large companies.
Well, I think there's the upside scenario too, which is automating work and augmenting people inside these companies to do their jobs more effectively. But like every technological wave, it also comes with risks. And I think some of the risks in this case are the most basic. You see companies aggressively pushing out these pilot AI applications. Maybe it's a chatbot that helps applicants on the website learn about jobs, or maybe it's a customer support app. these pilots get pushed into productions and basic security controls aren't followed. They don't have basic security controls about what the agent actually exposes to the end user. Do they expose credentials? Do they expose secret information? And we can help secure that and help these companies take these pilots into production in a way that helps their business and keeps them secure at the same time.
Because of the proliferation of these agents, at least here in the early going, Ty, like, is the next generation of cyber attacks, are they going to be on grander scale?
Well, I think that as we move forward in technology, it's always the case that we automate more, we connect more information. And I wouldn't say the attacks get more grand, but they get more novel. There are things we don't anticipate. That's why it's so important to get the foundation right. The first thing you have to do is have a foundational control of what the agents can access and the data they're exposed to. Then you really have a solid foundation to secure everything that goes on above that.
Something happened last week when Oracle, or a week and a half ago, came out with that guidance. Of course, Ty, I know you don't work at Oracle, but you've been in the tech industry for a while. Like, how does a company like that's been around for decades, come out with this amazing backlog? What is happening really at the ground floor of this industry?
Well, I think the technology industry, as you know, Brian, we get all excited about quarter to quarter. But it's really these innovations and these steps forward that take many, many years to build. Oracle has been working on their cloud infrastructure really for 10 or 15 years if you go all the way back to the Sun acquisition. So it's about putting these steps in place to benefit for the future. And that's what I feel like we're trying to do with AI. We've been working on this identity foundation for 10 or 15 years. And now we're in a perfect position to help the world move toward this agentic future by providing this key security layer.
You came out with generally well-received guidance just in late August. But in light of what we heard from Oracle and some other players in the industry, is your guidance, is it too conservative?
Well, we're very happy with our guidance, and we're very happy with where the business is. In the quarter, we reported strong momentum and big deals, strong growth, strong profitability, and also a record pipeline going into the second half of the year. So we're focused on executing the second half of the year, and we're seeing the trends that are driving demand are companies see a real opportunity to automate their businesses, make their people more effective, decrease costs, increase revenue, and they realize that what we do, which is building this identity security platform, is foundational to what they do, and we're excited to serve that up to them.
For the first time in a while, I heard you talk a lot about the business you're winning with government. How are you winning that business, and what does some of these government deals entail?
Well, in the quarter, many of the top deals in the quarter 7 of the top 10 deals were in the public sector, which is a very impressive number for us in a quarter that had a lot of big deals. And I think in the government, you're seeing a lot of what people don't understand. A lot of times the government, first of all, they invest a lot in technology. And second of all, they have a lot of legacy technology. Some people think big companies have legacy technology. Governments have a ton of legacy technology, and they're trying to modernize it. They're trying to move to the cloud. They're trying to be more secure. They're trying to deploy AI as well. And identity management fits right into that. It connects with every system they have, whether it's an old system or a new system, lets them support new initiatives, new applications, new kinds of citizen portals and citizen mobile apps. So we're really purpose-built for this transition they're going through, and that's, I think, what's driving that's what's driving some of these good results.
I was talking to Salesforce co-founder Mark Benioff, Todd, at the Goldman conference, and he was saying he needs fewer employees because of the agents he's deploying in his own company. How is AI impacting the insides of Okta?
I think what we're doing is we're taking AI and using it across the entire company. And what it's allowing us to do is really focus on growth opportunities, because we're all about growth and accelerating growth. And if we can take dollars and invest them in R&D, and those engineers are more productive because of AI tools, if we can make the customer experience better, get them faster time to resolution, we're already seeing that our customer satisfaction surveys are over 90% positive. And that's a huge acceleration because of some AI technology and the hours and the time we've saved in the customer support desk. So it's really a boom across the board. And for us, it's about taking those resources and focusing them on growth and making sure we can grow this business to meet the demand we're seeing from this market right now.
Palo Alto Networks, Todd, I'm sure you know this, is ready or trying to close its deal of CyberArk. How is that competitive landscape going to change what Palo Alto tries to get in here and try to encroach on your turf?
Well, I think that what we're bringing to the market is a simple value proposition, which is people talk about consolidation and using a single vendor for multiple solutions. And inside the identity market, it's still incredibly fragmented. So our position is that we're trying to consolidate the identity market. you talk to these big companies, Brian, and they have, you don't think they might have one or two identity management tools, or maybe in places they don't have any. But they have 50 or 60, even in a mid-sized company. So our value proposition is, listen, you need a one-stop shop for identity. It's going to be more cost-effective. More importantly, it's going to give you this solid foundation to deploy this agentic future. And that message is really resonating. I think Palo Alto Networks and Microsoft is like this, and Amazon and Google, all the big companies have their pitch about, hey, we're going to be the one-stop shop for something. I think for us, it's like we're the one-stop shop for identity, and we're seeing a lot of momentum on that. And I personally believe that it's not the best thing to have a one-stop shop for security per se, because security is a fast-moving business, and you want the flexibility to choose the best solution as the security threats arise, and you want innovation to come in and help you deal with those security threats. So I think it's good to keep your choices open in security while you consolidate and have a one-stop shop for identity.
For the past 24 hours, Todd, we've been debating a lot about what President Trump wants to do with quarterly earnings, potentially move to a semi-annual reporting period. Now, unfortunately for you, you were the first CEO on our network since this decision or proclamation came out. Would you be okay moving to semi-annual? Is there too much of focus inside of corporate America on quarterly earnings?
I think I'd be okay either way. I do like the opportunity to talk to investors every quarter about the business and the future and the vision of what we're trying to do. But I do think sometimes the industry gets too obsessed with the quarterly numbers and infers too much forward guidance and forward momentum or lack thereof from a single quarter. So I think a good combination of reporting numbers, maybe a little less frequently, but having the long-term strategic conversations with investors continuously would be the right balance.
Seems like a very reasonable approach to me. Okta co-founder and CEO Todd McKinnon, always good to see you. Appreciate it.
Thanks for having me on, Brian.
The love-hate relationship with quarterly earnings. We'll stay on this topic. On the one hand, we love quarterly earnings. Each month, the company releases its financial numbers, providing transparency to its investors on how it's doing. We get to listen to high-profile executives hop on a webcast and talk about every single positive known to man and woman, from innovative new products that may change civilization to how one-time expenses mean absolutely nothing. Ain't nothing to see here. Let's keep it moving, friends. But President Trump brings up an important point in wanting to do away with quarterly earnings in favor of semi-annual reporting. If we are inclined to build wealth steadily over time, doesn't that better align with hearing from companies formally twice a year with a more detailed snapshot of the business? Execs will still update investors on the business at investor conferences and on top networks like Yahoo Finance. So why not let them drive the business with the long term in mind instead of trying to make a quarterly number through various tactics? Don't agree with me? Then hit me up on X or LinkedIn at Brian Sozzi. I am eager to hear your thoughts on this topic, a topic I'm very passionate about. Coming up, Julie Hyman has you covered for Market Catalyst. Don't go anywhere unless it's to X or LinkedIn to reply to my trading day thought of the day. Talk to you soon.